this idea that there could be a second round of inflation, has been sort of making the rounds again lately since the introduction of tariffs. And I think when you look at the CPI swap market, you have to realize that the market is taking this idea very seriously. And what we're looking at right now is a 5-year CPI swap. So we're not talking about a short-term CPI swap. We're talking about something more medium and longer term, a 5-year number. And what's interesting here is that we've broken out of what I would call a 2-year base. I mean, basically go back to January of 23. This was the level that really held all that time. Multiple times we've tried to test this area around the 255, 260 range. And finally, just this week, we pierced above it. Now, of course, whether or not we hold this level and we continue to see these expectations go higher is a question. But I mean, if you're in the school of technical analysis and you look at this chart, you can't help but think that when you break out of a 2-year base, it has some significance. And you can almost make an argue that there's a inverse head and shoulders pattern here that formed with a neckline that's been broken. And that would suggest that we see higher and higher inflation rates. And I think that this is a really important topic, because obviously with stock market valuations where they are, where credit spreads tight as they are, the market overall in general is not really priced for a second wave of inflation. And, when you look more closely and you look at, 1-year CPI swaps, those have also broken out of what I would say has been a 2 to 3 year base. Clearly what looks almost like a bull flag has broken out and clearly breaking above resistance. And so this is, again, a theme that you're seeing across the swaps curve. And when you look at a 2-year swap also, it's got a very similar look here. Again, just trading sideways for a really long time, kind of making new highs here or getting close to them. And again, getting back to levels not seen in quite some time. And even when you go out to a 10-year swap, again, you can make a case that we're really close at this point to potentially breaking out and potentially putting in, higher highs. So right now, when you look at the 1, 2, 5, and 10-year swaps, I mean, you can make a strong argument that 1, 2, and 5-year CPI swaps have broken out of the range, and you could make a case that maybe the 10-year isn't really that far behind. And, what's ultimately driving this? Well, I think there's a bunch of different things that could be ultimately driving this. One reason is that we've seen copper prices obviously move sharply higher in recent days. When you look at the technicals alone, you can see we've had a really nice consolidation, and it looks like we've really sort of broken out here. You're seeing, similar movements in other metals as well, with silver, which has moved up really sharply recently, also trading towards the upper end of its range. We've seen metals like platinum all of a sudden come back from being dead for a really long time. Platinum's made a really big move in a really short period of time. I mean, that's a 50% move in the price of platinum, really just since the end of call it the middle to the end of May. Here it is right here, May 20th. And, again, when you go back and you look at where platinum is trading right now, obviously it's had a really big move. I talked about this with my subscribers the other day. It almost looks like you have a giant, inverse head and shoulders type of pattern that's forming. The neckline has been broken here. And, again, maybe we have a little bit higher still to go. But when you start looking around at some of these even commodities like cattle trading at all-time highs, and more interestingly, we've also seen something like the Baltic Dry Index, which isn't exactly, again, you don't really think about this as being very exciting, but, the Baltic Dry Index has made a little bit of a comeback here, trading up more recently. You've seen things like iron ore, which has really not done much of anything, all of a sudden start looking like it's coming back from a period of being dead. Here you can see big consolidation that's taken place. We're kind of bouncing off the lower low, and again, here's your trend line that you're kind of just curling up against, and so this is again, interesting. There's a lot of different measures of iron ore. Obviously, this is trading on the Singapore, but when you look at it on the COMEX, you can see a very similar, kind of setup here where it looks like it's, potentially breaking off of a downtrend. So, these are probably some of the reasons why you're seeing, inflation expectations moving up. On top of the fact that you've also seen, signs within the CPI report that, good prices are starting to go up again. And obviously, this is going to probably feed into 10-year rates. One of the reasons why I tend to think that 10-year rates can go higher are because when you look at the direction of inflation swaps and inflation pricing, it's suggesting that inflation rates are going higher. And when you take this swap and you add in a 10-year yield, it's basically, again, it's nearly the same exact chart. And you could argue which one leads what, but they both basically trade almost together. And so, this is an interesting relationship between the two, and it would suggest, you would think that 10-year rates move higher from where they are, and 30-year rates move higher as well. And generally speaking, when you think about when you look at a high yield credit spread, they're not as tight as they were back in February. But clearly, when you look at this chart, they haven't been this tight in almost a decade. And you can go back and look even further and realize that the last time credit spreads had been that tight were back right before the GFC in June of 2007. So what this is telling us is that credit spreads are historically much tighter than what they're usually. And in fact, when you go back and you look in 2014 really through 2022, credit spreads tended to bottom around 3.3%, and right now they're trading at 2.9. So that would suggest there's potentially just some upside to get back to the lower end of the historical range. And this is sort of your risk gauge, right? If you start seeing credit spreads going higher, that's an indication of more of a risk off type of move. And so again, in a world where credit spreads are super tight, we know equity markets have gone to the moon. So it would suggest that markets probably aren't really priced for a situation where, we were to see inflation sort of come back. Even if it came back to 3.5% or 4%, it would obviously be enough to push 10-year and 30-year rates up, since they're only trading at, a 10-year only trades at 4.5%, 4.4%. So, if you started to see inflation coming back to 3.5% or 4%, you would think that a 10-year yield would move higher as well. So, generally speaking, I think you have to take these signals you're getting from the inflation side of the market, watch closely, because if this continues to evolve, then it really does pose a potential risk to risk assets in the future. Please remember to subscribe to this channel, like this video, share it with your friends. Have a great afternoon. Bye.